Hello, Accounting Superstars. Welcome to the Accounting Superstar channel. I'm so glad you're here. I'm Professor Don Bush. I've been teaching accounting for about 30 years and been a CPA for about that long. And today we're going to learn about accounting for income taxes, deferred tax assets, number 2. This is the second example of deferred tax assets. It's pretty easy. If you have been following the other examples, you'll get this example too. So here we go. I have 2 sets of financial information for you. The first set is based on generally accepted accounting principles. We have revenue, expenses, pre-tax financial income, income tax expense. And down below in the second box, I have financial information based on IRS regulations. And as you ought to know by now, there are some significant differences between the two. In 2001, when we get to construction, performed revenue. They did a job for somebody. And they also promised a warranty. And they expect in the future that this warranty cost will be about $10,000. They're not sure exactly when and how, but they expect the warranty to cost them about $10,000. And so I've got that included right here in the expenses. Now, when it comes to the IRS, you're allowed to deduct warranty expenses when you spend the money to fix the product, when you spend the money to pay your workers to fix whatever's wrong. So what's going on here in 2001, when we get to a construction, promised warranty work, but they didn't actually perform any warranty work in 2001. They actually performed the warranty work in 2002 and 2003. So here's how it works. For taxes, we're not allowed to deduct warranty work in 2001 because no warranty work was done. But in 2002, some warranty work was done, and in 2003, some warranty work was done. So in 2002, there was $5,000 of warranty work performed, and in 2003 there was $5,000 of warranty work performed. And that's why there's a difference between expenses and tax deductions of $5,000. It's the warranty work. Now the total expenses, grand total, are the same either way. $190,000 under GAAP, $190,000 under the tax regulations. The income tax expense is $6,000, got it right off the top chart, $6,000. The income tax expense for 2002 is $8,000, got it off the top chart, and so on and so forth. The grand total is $22,000. And the income tax payable according to the tax forms is $8,000. I just got it off the chart here, $8,000. $7,000, got it off of this chart here, $7,000, and the same thing for 2003, and it all adds up to $22,000. So here's what's going on, folks, is that the income tax expense for 2001 was $6,000, the income tax payable is $8,000, which means that in a sense they're prepaying their taxes by $2,000. They're paying their taxes in advance, which means in future years they won't have to pay as much tax. This is called a temporary tax difference. So this temporary tax difference of $2,000 is going to get reversed out in 2002 and 2003, which it does here. So the income tax expense in 2002 is $8,000. The income tax payable is $7,000, so the deferred tax asset is being reversed out. Same thing in 2003. By the end of 2003, it is totally reversed out. So let's go down to the journal entries. So here's the first set of journal entries, and they're in yellow. I color coordinated it so it's easier to follow. So the income tax expense of $6,000 is debited here. Income tax expense $6,000. Income tax payable is a liability, and I'm crediting it for $8,000, which is a difference of $2,000 here. $6,000 plus $2,000 is $8,000, so our journal entry balances. And we have a deferred tax asset. And one more time, the deferred tax asset is like prepaying your taxes in a sense. Coming down to the GAAP balance sheet, the deferred tax asset is $2,000. We get it right off the journal entry. And coming over here to the income statement, The income tax expense here, currently we owe the IRS $8,000 and we get it off that journal entry. What is being deferred is $2,000, and so the income tax expense nets out at $6,000, which is what we want. Coming down to the next year, so this journal entry is in a blue color. Income tax expense is $8,000. I got it right off the chart here. Income tax expense $8,000. What we have to pay the IRS, income tax payable, is $7,000, and that comes down here as a credit. The difference is $1,000, and so I'm crediting deferred tax asset by $1,000, which means I'm reversing it out. So the deferred tax asset on the balance sheet is $1,000. How did we get the $1,000? Well, we have a negative $2,000 here and a $1,000 here. So the deferred tax asset started out at $2,000, and it is being reversed out by $1,000. So we have $1,000 left to be reversed out. Over here to the income statement, according to GAAP, the current taxes due is $7,000. There it is, right off the journal entry. The deferred tax asset being reversed out is $1,000. Brings us a tax expense of $8,000, and that is what we want. We could check with our journal entry and check it with the chart. Let's go down to the final year. Here we are. This is in a pink color. Income tax expense $8,000. Get it right off the chart. Income tax payable, get it right off the chart. The difference between the two is $1,000. So the deferred tax asset is being reversed out by another $1,000. Down to the balance sheet, deferred tax asset is $0 because it is totally reversed out by the end of 2003. Started out as $2,000, got reversed out by $1,000 and reversed out by another $1,000, and so it is totally reversed out by the end of 2003. Over to the income statement. The income statement here, current, is how much is payable to the IRS, $7,000. We're reversing out the deferred, and which makes our expense $8,000, which we can double check here with our journal entry or off the chart. So everyone, that is how the deferred tax asset works. If this video helped you out, hit that like button and hit the subscribe button, and that way I know that you are getting something out of these videos and I'll make some more for you. Until then, over and out.